Hello everyone. Today's video is on the topic, Crash of World Economy in 2007. How did this started? We will have to understand everything from the beginning about each and every person. First we will talk about Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac play a vital role in supporting the U.S. home mortgage system. Rather than directly lending money to individuals, these organizations purchase mortgage loans from banks and financial institutions that originate them. This process ensures a continuous flow of funds to lending institutions, allowing them to write more mortgages and help more people purchase homes. Fannie Mae, originally chartered by Congress in 1938 during the Great Depression, revolutionized the mortgage lending industry by enabling lenders to extend long-term loans with smaller down payments, thereby expanding the mortgage credit market. For the first 3 decades of its existence, Fannie Mae was a government-owned entity with a near monopoly over the secondary mortgage market. In 1968, Fannie Mae was privatized, and Freddie Mac was created in 1970. Asset-backed securities, ABS, are collateralized loans, where borrowers give something as collateral in exchange for the loan. In 1977, Louis Ranieri introduced mortgage-backed securities, MBS, a class of ABS that focuses on mortgage loans. For instance, if a bank has given loans to 5 houses, the bank will have 5 houses as collateral. Investment banks then purchase these collateralized loans from the banks to provide them with more capital to extend loans. These investment banks can have, for example, 25 collaterals that they combine into one MBS. In 1980, Freddie Mac began selling mortgage-backed securities, MBS. It's important to note that both Freddie Mac and Fannie Mae were chartered by Congress and tasked with federally mandated roles in maintaining the stability and functioning of the mortgage market. Despite being public companies whose bonds and shares were widely held by investors, most investors assumed that these entities were too big to fail, given their significance. In 1987, collateralized debt obligations, CDOs, were introduced as a complex structured finance product backed by a pool of loans and other assets and sold to institutional investors. CDOs are typically divided into tranches or levels, including equity, which has higher risk and high returns, mezzanine, moderate risk and moderate returns, and senior, low risk and low returns. In the event of defaults on CDOs, the safest group is the senior tranche, with the equity tranche being the first to fall. The main difference between CDOs and MBS is that MBS offers a fixed amount of return and can have tranches, which will be discussed later, while CDOs consist of more ABS, such as auto loans, credit cards, and royalties, and do not offer fixed income. Instead, tranches are determined according to the loans, and companies may sell CDOs as a bond for different tranches to investors. In 1989, Freddie Mac transitioned to a fully public company. One key difference between Freddie Mac and Fannie Mae was that Freddie Mac provided funding to smaller banks. During the early 1990s, as the internet began to gain popularity, the stock market experienced a surge in growth. From 1990 to 1997, the percentage of households in the United States owning computers increased from 15% to 35%, with computer ownership shifting from a luxury to a necessity. This trend was accompanied by a decline in interest rates, which increased the availability of capital. As a result, many investors were eager to invest in any .com company, especially those with internet-related prefixes or a .com suffix in their name. During the same period, many startups listed themselves on the Nasdaq exchange through initial public offerings, IPOs, and people were curious to invest in these stocks, leading to a stock market bubble. By the 2000s, the tech bubble burst, giving rise to the housing bubble. As investors pulled out of the stock market following the .com bubble burst and subsequent market crash, they moved their money into real estate. Concurrently, the U.S. Federal Reserve cut interest rates and held them down to combat the mild recession that followed the technology bust, as well as to assuage uncertainty following the September 11, 2001, World Trade Center attack. As a result, even the buyers of collateralized debt obligations, CDOs, began to shift their focus to subprime mortgage loans. Subprime mortgage loans are loans extended to borrowers with low credit scores or financial instability. A subprime mortgage is a type of loan that is typically granted to borrowers with poor credit scores. Unlike prime conventional mortgages, lenders view these borrowers as having a higher risk of defaulting on the loan. The demand for subprime mortgages increased during the housing market boom as these loans offered higher interest rates, and if a borrower defaulted, the lender could sell the house at a higher price due to the rising market. Investors saw the potential for high returns with seemingly low risk. It is important to note that all asset-backed securities, ABS, were required to obtain credit ratings from certified rating agencies to provide investors with an understanding of the risks associated with these securities. The credit rating industry is dominated by three major agencies, including Moody's Investor Services, Standard & Poor's, S&P, and Fitch Group. Fannie Mae and Freddie Mac guaranteed mortgage-backed securities, and investors believed these securities to be safe investments. However, rating agencies began creating mezzanine tranches to create higher-rated CDOs, even though they were originally rated as BBB. The issuers of these CDOs paid rating agencies to rate them as AAA, even with the inclusion of subprime mortgages. As the housing market boom continued, insurance companies like AIG wanted to get in on the action and began offering credit default swaps, CDS, on these securities. They believed that the AAA rated bonds or bundles would not fail, and as a result, everyone appeared to be earning high returns without apparent risk. Equity investments are associated with high risks, expensive credit default swaps, CDS, and lower payouts for insurance companies in case of failure. Mezzanine investments have moderate risks and require a moderate amount for CDS. Senior investments, on the other hand, have low risks, cheap CDS, and higher payouts for insurance companies in case of failure. In 2002, banks were eager to sell CDS on senior tranches of collateralized debt obligations, CDOs, or mortgage-backed securities, MBS, or both. They believed that since 80% of the bonds were in the senior level, there was little chance of the CDOs or MBS failing. No one was willing to buy these CDS or bet against them, thinking they would fail. However, in reality, 95% of the total CDOs and MBS had been given AAA ratings by rating agencies, despite their poor worthiness. No agency wanted to examine their worthiness due to the booming housing market and great cash flow in the economy. Almost 80% of these CDOs consisted of housing loans and subprime loans. The start of the crash occurred in 2004 when the Federal Reserve started to increase the interest rates of homes. By 2006, the interest rates had increased from 1% to 5.25%. As the interest rates for subprime mortgages also increased, many people were unable to make payments, and the value of their homes became less than the amount owed on their mortgage. Additionally, the increasing interest rates made it difficult for people to afford new homes, leading to a decline in house prices. In the world of finance, Lehman Brothers was a major player heavily invested in the real estate market. Between 2002 and 2007, the company's profits were soaring, with their share prices reaching an all-time high of $86 and revenue of $68 billion in 2007. Their market capital was valued at $60 billion. However, it was later discovered that they had invested $78 billion in so-called AAA MBS and CDOs. The company even acquired 5 other firms, one of which was solely invested in SPM. By the end of 2007, Lehman Brothers was holding $5.6 billion of SPM. Additionally, they invested $22 billion in real estate themselves and went into debt to borrow money at a low interest rate of 1%. Meanwhile, AIG had invested hundreds of billions of dollars in insurance for those CDOs and MBS, promising they would not fail. But when those who had bought insurance on those bonds were not able to pay, AIG was unable to meet its obligations. They also had to pay returns to those who had shorted against their CDS. As mid-2007 approached, the Feds began to realize that the entire American economy was heavily invested in the housing sector, with many banks also investing in CDOs and MBS. Additionally, large sums of money had been invested in CDS by a select few. By the end of 2007, the Feds were aware that a significant problem was looming and action needed to be taken. Although the housing market continued to decline, many major players continued to hold on. On September 13, 2008, the Federal Reserve came to the realization that action needed to be taken soon in response to the impending crisis. A closed-door meeting was held with Lehman Brothers and other major financial institutions to discuss potential bailout options. The following day, on Sunday night, Barclays decided to step in and bail out Lehman Brothers. However, a phone call from the UK to the Barclays middleman at the time resulted in a decision against the bailout. In response to the failed bailout, the famous quote, "The Brits have fucked up the world again," was uttered. Consequently, on Monday, September 15, 2008, Lehman Brothers filed for bankruptcy. The market crashed by 7% on that single day and 48% within 6 months.